Hi guys, welcome to this Money Control live feed. You're watching Morning Trade with me, Nandita Khemka. Well, over the next 30 minutes, we'll be talking about all the cues for trade, the cues coming out of Gift Nifty, all the stocks that will be in focus, and of course, we'll also be getting all your stock-related queries answered by a technical expert on the show. So if you have any queries, send them in to us on our YouTube feed and we will take them up. But before we go any further, let's take a look at the top headlines at this hour. Wall Street ends with a positive bias as July CPI inflation comes in at 3.2% versus estimates of an increase of 3.3%. Core inflation too rises less than expected. Asian markets too open mixed, rather following positive cues from Wall Street. The Nikkei is shut on account of a local holiday. The Gift Nifty is implying a mildly higher start for the Indian market, although I think it has slipped in the trade after a positive open. Oil prices fall as expectations of another Fed hike ease following a better than estimated US inflation print. Gold too ticks higher on expectations that the Fed is reaching the end of its rate hike cycle. Her Moto delivers an operationally strong set of numbers. Margin expands for the fourth straight quarter, higher by 260 basis points on a year-on-year basis. In key earnings to watch today, Apollo Hospitals and ONGC will report first quarter numbers. From the broader markets, watch out for numbers from Voltas, HCL and Nykaa. Well, let me get on board our first guest for today. Joining me is market expert Ajay Bagga to tell us what to expect from the markets going forward, and of course to ask him how he's reading into the latest US inflation print. Good morning, Ajay. Good to have you on the show as always. Before I talk about what the RBI has done and what it means for banks, let me get in your thoughts on the US CPI print that came in last night. Softer than expected. Now there are, the concerns over another Fed rate hike of 25 basis points have seemed to be easing. Would you say that, in September meeting, we could look at a prolonged pause, at the start of a prolonged pause when it comes to the US Federal Reserve?
Yeah, I would agree with your surmise, Nandita. I think we are at the end of the US hiking cycle. The inflation is clearly going downwards. There is a small blip between June to July from 3% to 3.2 in the headline inflation, but the core inflation actually came down. And if you see the month-on-month gains for the last 3 months and you annualize it, you're looking at a 2.5% kind of a print for the headline inflation as well as the core inflation. So we are expecting a less than 3% print for the headline inflation in the US by the end of this year. And going into next year, towards the end of next year, we will be very much near their 2% target. So I think the rate hike cycle is done in the US, and that's the market consensus to a large extent. Even in terms of a recession risk, that has receded. The Atlanta Fed GDP now number coming in very strongly at 4.1% for this quarter, which is running now. Nearly half of the quarter is over July to September quarter. So 3 quarters of very strong growth in the US already. That's not a pointer to a recession or an imminent recession. Looking at a soft landing or a no landing at all kind of a scenario.
Well, that's a good scenario, so to say, when it comes to the global markets. But I also want to get your thoughts on the, kind of risks that have emerged for the Indian markets now. Over the last few sessions, we've seen FIIs turn net sellers. And then yesterday, I was reading the Jefferies report on India, where they said that India's Goldilocks position is now in question. Crude rising back to $85, $86 levels. India, in fact, has been underperforming the MSCI Emerging Markets Index over the last 1 month or thereabouts. Do you see these as, short-term risks, or would you say that, they could boil down to something a little more serious going forward?
Yeah, if you, take it back to September 2021 and extrapolate it now, we have hardly given any return, and in dollar terms, there has been no return. So we are not an outperforming market. Maybe from March end to now, we did a catch-up rally. But overall, a lot has to be delivered in the Indian markets. So I'm not so worried on that sense. India is a multi-year, investment thesis for most of the long-term FIIs. So those flows will stay. And if you compare it to China, we don't know what is going to happen next in China. And that situation is quite much more serious. Though their valuations have also come down, but their concomitant risks are very high. In contrast to that, the big risk for India, which the market will see, is the 2024 national elections. Going into that, we are expecting sideways markets. Normally, you will start seeing the opinion polls coming in over the next 3 months, and that will give some direction to the markets. But overall, next 6 months could be tough for the Indian markets.
All right, some risks emerging for Indian markets over the next 6 months. But, I want to get in your thoughts on banks now. Of course, yesterday we saw RBI holding fire, but it was the incremental CRR move that, came in as a disappointment. Even though it's a temporary move, Ajay, do you think that would kind of put the bank margins under further pressure? And going forward, we saw SBI already see some bit of margin compression coming in as deposits are getting repriced. But do you think this move could further, weigh in on banks? And do you think banking no longer is a hot story, at least at the current juncture?
No, I think it was an avoidable sentimental dampener. The impact is not so much, just calculating it roughly, banks put on about 2 lakh crores of deposits and CASA every month. In the economy. Last year, we did 22 lakh crores of incremental deposits in the whole year. So just roughly at most, maybe 2 lakh crores, even with the 2,000 rupee inflow. And out of that, so 2.5 months of inflows are getting impounded. Say 5 lakh crores, 10% of 5 lakh crores, 50,000 crores gets impounded in this. And there the banks would have earned 6% by placing it on the RBI window, 6.25 on the overnight windows, and they're going to earn 0. That's the impact. So maybe 2,000 to 3,000 crores on an annualized basis. And as you said, if it's a limited 1-month move, then it becomes really non-material. If it stays, which I think they will have to keep it now, because, just like the cess that we pay on our taxes, it starts as an incremental 0.5%, 1%, and then it's very difficult to get off the tiger. Though 2016, when they put this kind of an incremental CRR, at that time they withdrew it by December middle. So a lot will depend on how strong is the credit growth, what deposits are banks incrementally able to mobilize to meet this liquidity going out. But maybe about 50,000 to 75,000 crores of liquidity goes out, which is not big in an Indian banking scenario with 190 lakh crore aggregate deposits and 145 lakh crores of credit. The big issue is banks have really turned the corner. Banks, the credit is growing. RBI is worried that unsecured individual credit is really taking off too fast for RBI's comfort. So they will signal, they will try to hold that back so that 2 years down the line, 3 years down the line, we don't have a credit mess from the individual side staring at us. That is really taking off both for the NBFCs as well as the banks. But overall, banks stay very robust and a large part of our market, and they will continue to do well. And Nandita, if we take it to a 3-year, 5-year basis, who's going to fund as India's consumption goes from 160 lakh crores to about 350 lakh crores over the next 5 years? Who are the funders for it? It's the banks and the NBFCs. So that is not going away. So any long-term investor in India, the first port of calls is the banks.
Right, that's the view on banks. But, Ajay, one pocket that has been doing extremely well and has picked up steam, or you could call a dark horse, is the pharma pack. In recent times, you've seen the likes of Cipla, Dr. Reddy's sitting at fresh highs. Of course, there's the talk of promoters' stake sale in Cipla, which is, kind of pushing the stock higher. But what are your thoughts? Should one look at this pocket now?
Yes, absolutely. For about 8 to 10 years now, pharma had one rally in the last 10 years, and then it has been in the doghouse, very underowned, very unappreciated, very unloved. Contrarian moves started about a year back in pharma. Some bottom picking happened, and pharma, is 4 or 5 kind of companies. There are the domestic companies, there are the branded formulations, there are the generic players, the predominantly US players who get impacted by these FDA warnings. Then there is the entire diagnostic sector and the hospital sector. Hospitals are doing very well. You have seen the gangbuster results from hospitals, and they are projected to keep doing well. It's a very big scarcity premium embedded into the hospitals, and government is, launching a lot of new government medical colleges, government hospitals, but the demand is so huge. We are so underserved in that it's a multi-decade story in hospitals. Same way, diagnostics, there has been that COVID boost and then the shortfall and margins coming off this quarter, but they're very well-run companies, cash positive companies. Then coming within pharma, the US revenue, de-risking has happened to a large extent in the generics and the contract manufacturer companies. The API shortages, all those have also gone away to a large extent. Chinese have increased the prices, and we are still dependent a lot for inputs on Chinese. So that is still having an impact. But as we have seen in our own chemical players, overall globally, it's an oversupplied market. So that will also bring in some amount of relief for that segment of the pharma players. So overall, a good place to be in. And you have ETFs dedicated to pharma. That's a very simple way to play it, or do a stock picking. Again, I would say hospitals and these generic players, they are the ones who will, out of these 5, 6 segments, they might outperform.
All right. That's the view on the pharma pack. Then a pretty bullish view coming in. With that, Ajay, I wish we could continue with this conversation a little longer, but we are running out of time. But as usual, it's a pleasure having you on the show. I look forward to touch base with you soon sometime. Thanks a lot for joining.
Thank you.
Well, with that, let me also get on board our technical expert for today, Raja Venkatraman of Neotrader is joining in. Good morning, Raja. Great to have you on the show as usual. We have been struggling to reclaim, get back above that 20 DMA mark, which is placed at somewhere around 19,630 or thereabouts. Yesterday, of course, there was the RBI dampener that played out, and we gave up 19,600 as well. But would you say that there are chances of regaining that 19,600 mark, given the fact that global cues in terms of US CPI print are looking pretty encouraging?
Yeah, so first of all, good morning, and thank you for inviting me to the show. Now, the whole agenda, what we are seeing right now in the market has been quite challenging. And one of the primary reasons have been that the Bank Nifty has not been able to live up to the expectation. So as a result, what's happening is, despite the attempts which we have seen so far, the 45,000 levels have not been able to surpass with conviction. And the same is with 19,700, which is a key level to watch out for as far as the Nifty is concerned. Now, continuously at these levels, there has been some supply emerging. And when you take a look at the kind of caveats which RBI has put into yesterday's RBI meet, we can see that there could be some continued pressure that can emerge from the banking space, and that can keep the markets under pressure. So I believe that the entire market for the remainder of the series could move in a range-bound fashion, because when you also take a look at the kind of Q1 numbers that are coming out, they're not been really encouraging. So with all these factors, with global cues also, and yesterday, when I was tracking the US markets, they began the day quite well, and they ended in a very subdued manner. So when you combine all the clues that are coming in, I don't think that we should be having an extremely bullish outlook as we head into the remainder of the series. Instead, you should look to do a two-prong play, maybe go longs in some strong sectors like, say, pharma, right? Pharma is a good play. You can look at pullbacks to buy into, or maybe metals. But then largely pharma, metals, and IT would be some sectors where you can consider some bullish prospects. But then there are other weak prospects like FMCG, and even auto is turning weak after a strong rally. So that's how one should play out the remainder of the series.
All right, that's the view coming in on the market and the sectors to watch out for. But let me get in your thoughts on Z, given the fact that it got the NCLT approval for merger with Sony, and that was supposed to be the next big catalyst for this company, or for this stock rather. Today we have CLSA coming out with a report. It has a buy rating, target price of 300 or thereabouts, which is just very close to where the stock is right now. And it believes that the valuation is pretty compelling. But Z, how does it look? Yesterday it was up 16%. How much more of an upside are the charts indicating?
Yeah, the case with Z is that there are news flows almost every 2-3 weeks, and the markets are only reacting to the news flow. And I believe that Z is already it's the price movement is already priced in, and once again you can continue to see a volatile scenario here. So I do not believe that if you are having a very short-term outlook, then Z is not a stock to consider. But then if you're having a long-term outlook, and if you're looking to invest into this stock, considering the kind of the merger news and also the kind of flows which you want to track for the next few years, then you can consider Z, maybe with an outlook of, for the next 1.5 years from now. Then you may see a price band of around 600 emerging. Otherwise, Z continues to be more of a trading prospect. Yes, the day was quite good yesterday, but then any pullback towards the region of around 260 to 270 is only a suitable prospect to buy into.
All right, there was a query actually on our live feed on Z. Indra Reddy wanted to know your thoughts. I hope that answers your query. But let me also, talk about the stock of the day. Her Moto reported its numbers yesterday post market hours. Profits have seen a 30% jump on a YOY basis. Strong operating numbers and margins have expanded for a fourth straight quarter by 260 basis points or thereabouts. I think the stock has turned a bit volatile over the last 5 sessions or thereabouts. It's up 3%. There has been weakness in entry-level two-wheeler sales, as we've seen. And over the last 1 month, the stock has seen fairly volatile going. On the charts, would you say that there could be some bit of downside going ahead?
I would not say there could be some downside, but yes, it will be more of a consolidation here. So I believe that as long as the 2900 levels are holding, one should be fine with this, and it will be more of a range bound action. So, but if you're looking to invest into Her Moto, then this is not the right time.
All right, not the right time to look at a Her Moto. LIC, what's your thought on that one? Multifold jump in first quarter profit, but VNB margins have been pretty flat on a YY basis. On the charts, LIC, what would you suggest one does now?
Yeah, LIC Housing, yes, it came out with stellar numbers, but the entire move in LIC Housing is similar to Z, where you have very few days of gains. You have 20 days of gain, and you have got 80 days of pain. So when that kind of movement is there, you have to be very careful. Yes, the stock is taking time to go up, and it will eventually go up, but then this is more of a trading stock. So if you want to buy LIC, the levels are only emerging at around 390 to 400. So at around 390 to 400 would be a good opportunity to enter into LIC with an outlook of around maybe around 650 and 750 are two targets by the end of this year. But then you'll have to wait it out, and that's what is the problem when you take stocks like these.
Raja, actually, I wanted to get in your thoughts on LIC, Life Insurance Corporation, given the fact that the numbers came out yesterday. Stock hasn't done much, it's just up 3% or thereabouts over the last 1 month. So for a life insurance corporate, what would you suggest?
Yeah, LIC on the other hand looks to be tiring out right now. So if those who are holding LIC should book profits here, and because the stock seems set for some downside now.
All right, that's the view then. But today HCL will be reporting its numbers. We have a query coming in from Hemant. He wants to know your thoughts on what he should be doing with this stock. Defense stocks, I think they came under some bit of pressure after the kind of rally they have seen, recently. But how should one position themselves in an HAL ahead of numbers?
Yeah, if you take a look at HAL, it's moved up 1,000 points from June. So June, July, August, within 3 months, you have clocked 1,000 points, which is almost around 30%. So there is bound to be some pressure emerging here. Now, when you take a look in the last 1.5 months, the stock has actually consolidated at these levels. So as long as the prices are holding the levels of around 3,700, one should continue to hold on to this. And if the results are good, then we may see a breakout above 4,000 also, which is very much possible. And considering the sector is very much in play, be it HAL, be it BEL, and all of us know about Zentech. So every stock associated with the sector is seeing some very positive traction. So there is no need to exit this stock. In fact, look at accumulating the stock at lower levels, and lower levels will be in the region of around 3,400 to 3,300.
All right, that's the view on HAL. But let me also talk about HCL Tech. It has bagged a $2 billion deal from Verizon. From the IT pack, we've seen a very smart rally in shares of Tech Mahindra, but HCL Tech has been pretty flat. How would you advise investors to look at HCL Tech now in the IT pack?
Yeah, see, these kind of news flows are not new to the IT space. They keep coming in, but the IT sector itself is under some pressure. And the rallies which you see in between should be taken with a pinch of salt and more of a trading rally, either on the upside or on the downside. And one should not be looking at the IT space from an investment bet for the entire year, because the whole scenario is having a lot of pain. But yes, if you have surplus capital, then IT space could be looked into, because it is at a very low valuation area where you will have a chance to accumulate certain prominent stocks and invest it into the next few years.
All right, that's the view on HCL Tech and the IT space. But let me come to metals now from IT. SAIL reported, numbers yesterday. Earnings were above estimates, even though profits have dropped somewhere around 73% or thereabouts. We have a query coming in from Saeed Khan, wants to know whether or not it's a good time to enter and hold for the short term. And there's another query from the metals pack itself, Vedanta. Madhusudan wants to know your thoughts on Vedanta. So these two stocks, how are they looking on the charts now?
Yeah, SAIL definitely is looking poised for further upward traction. But yes, if your question is, should I enter now? The answer is no, because it has run up quite a bit. And I would advise you to wait for a lower levels around 82 to 84. That will be a good support region to enter. Now, when you take a look at Vedanta, Vedanta is not reflecting the true spirit which has been seen in the metal pack. And in fact, there is some steady downward traction. And this stock continues to be under a lot of pain. And now the entire movement looks like it's going to head lower. So if you're having this stock, then you'll have to look either at rallies towards 270, 275 to exit, or you should exit it below 235.
All right, that's the view on Vedanta. Let me take up a query on BLS International coming in from Meet Jaitley. He wants to know whether he should be holding or selling the counter. Stock has been up somewhere around 17% over the last 1 month, and in fact it's very close to 52-week highs as well. Hold on and wait for further up move?
Yeah, this stock is set for more upward traction, and the kind of work they are doing in, and the kind of travel which especially from India, has seen a phenomenal rise, and they are in those services. So they are definitely benefited by the wave of travel enthusiasm, and this should continue. So one should hold on and also keep some allowance for adding to their portfolio in the support region of around 225 to 230.
All right, hope that answers your query. But getting in the last query for the day, this one is on Hikal. This gentleman, Rakesh, has a query on it, wants to know what to do with the stock. He has a holding period of 3 months.
So when you take a look at this stock, there is hardly any movement which we have seen so far. So it becomes very challenging when you take a look at higher levels. And with the current kind of movement which we are seeing, so there is some pain which is seen in the overall movement. So I would advise that hold on to this stock and keep a stop loss at 280. If 280 is given up, then look at another opportunity in some other stock.
All right, that's the view on HCL. But with that, we've come to the end of this query segment. But before I let you go, Raja, leave us with some stock recommendations for our viewers.
Yeah. So, like I mentioned, I would like to go with a two-prong approach. So, I have decided to go with buy in Canfin Home. There has been a good sharp pullback which I've seen, and it's taking good supports out there. So, buy at around 751, 752 with a stop loss at 742 for a target of 766, and a sell in HUL. The FMCG space is seeing some weakness, so sell HUL around 2540 with a stop at 2560 for a target towards 2515 to 2500.
All right, those are the stock recommendations coming in from Raja this morning. With that, Raja, thanks a lot for joining in and sharing your thoughts with us, and of course answering all our viewer queries as well. Wish you a very happy weekend.
Same to you.
Well, with that, we've come to the end of this edition of Morning Trade. From me and the entire team that put the show together, thanks a lot for watching. But coming up next is Opening Bell, so stay tuned for that.